and welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy Alloway.
So, Tracy, we are here at the Milken Institute Conference in Beverly Hills.
I know. It's very fancy.
It's very, how's it been going for you so far?
It's been fun. I talked a lot about credit. I watched your panel about crypto, and I have to say there were definitely more people at the crypto panel than there were at the credit panel.
And also, every panel that I've seen that's not about crypto.
Someone asks a question.
Yeah, they're like, oh, what's your opinion about crypto, right?
Yeah.
Like everyone, no matter what, people just like want to know about it.
Someone from the audience submitted a question about how crypto would impact inflows into investment grade. And it, interesting thought.
Well, crypto is one of those things too, where regardless of, everyone gets an opinion on it, regardless. So everyone wants to know everyone's take, even if it's not their specialty.
This is very true.
But I'm very excited because today we're going to be speaking to someone who knows a lot about crypto, not just a tourist. And I think a topic that we haven't really talked about that much is blockchain architecture and design. And, all of these panels, like everyone's talking to, it's like, they're super like fanciful. It's like, oh, it's going to create this world of like openness and transparency.
Right.
And it's going to cut out all the fees and it's going to be so great. Which is really weird because when I think of blockchains, I think of high fees in low settlement or long settlement times and basically like all kinds of interesting trade-offs and many things that are worse than the existing financial system. So I feel like people are jumping over some like basic architectural points in this whole conversation.
Right. The other thing that gets me, especially at conferences like this, is everyone wants to talk about crypto. Everyone seems to have an opinion about it. But I have my doubts about whether people actually understand the underlying technology and whether or not they're differentiating between different blockchains and things like that. I think people might understand the basics, like proof of stake versus proof of work, layer 2 versus layer 1 or whatever. But like within those technology buckets, I don't think people are really thinking about the nuance.
No, it's a lot of like, it's all just going to be really good and it's going to be really great for financial inclusion and democracy and all that stuff. So anyway, let's have a real conversation about how these chains work and what you can do with them.
Let's do it.
All right. I'm really excited. Our guest knows a lot about this stuff. We're going to be speaking with Arthur Breitman. He is the founder and creator of the Tezos blockchain project, one of the sort of original projects that thought about smart contracting and malleability in a way that, much more advanced than, or seemingly more advanced than what you can do on, say, Bitcoin. So we're going to talk about what you could do with the chain. So Arthur, thank you so much for coming on Odd Lots.
And thank you for having me.
We've been interacting on Twitter for years and years, so I'm excited. I'm excited that you're here.
Yeah, me too.
So, Arna, what do you think when you hear all these people at these conferences and you're here too, and they're like, oh, it's gonna be really cheap, it's gonna lower the fees for everything, it's gonna be super fast, transparency, financial inclusion, it's gonna save democracy, it's gonna save the planet, etc. Like, what goes through your mind?
I mean, I think some of it is true, and some of it is false in terms of reducing the fees compared to traditional financial infrastructure. I actually think this is one of the real ones that we can actually do this. Yes, we can lower the entry cost for creating financial products or financial systems, make it a little more innovative, and develop these things much faster than they have in the past. I do believe that you can remove a lot of intermediaries. And a lot of the friction in the financial system comes from the fact that you need to rely on trusted intermediaries. As an intermediary, you have oftentimes a big opportunity for fraud.
Right.
And monitoring that fraud has a lot of cost. I mean, also, you have to deal with only a few people who are going to be trusted. If you can get rid of that, you can actually generally reduce costs. So I do believe this part of the story. I don't know that it's going to save the planet and do all this grandiose thing. I have a story I have about this is I once gave a talk at some sort of TED-like event, and it was about the promises of blockchain. And I gave an example for some of the overhyped ideas. And I said, well, imagine, for example, that we're going to put plastic bags are killing turtles, but the problem is we don't know where they came from. If we could identify who leaked the plastic bag, it solved the problem. So let's put the plastic bag in a blockchain and we'll save turtles. And I gave that as the example of like some of the nonsense you could see.
Right.
And someone pitched me that exact idea the next month.
That's amazing. Just going to fees, though, I mean, a very cynical person would say that the fees exist because, yes, there are underlying costs like fraud and KYC and AML and stuff like that. But if you were being very pessimistic about the whole thing, you would also say that financial intermediaries, traditional financial intermediaries, they like to make money. And a lot of those fees are opportunistic. So I guess my question is, like, do those fees actually exist because of what the intermediaries are doing and the cost, or because of the way the system works? And how do we make sure that in crypto, we don't end up with centralized intermediaries that are going to charge big fees anyway?
I mean, I think everyone who's in business likes to make more profit and likes to charge more fees. And people are going to charge whatever amount of fees they can get away with in general. So at some point, there's competitive pressure, right? And in finance, it's true that sometimes a lot of the competitive pressure is not present. You'll have people pay, 1% commission on a trade because they're doing it through a private bank, and they trust the private bank and do good execution and so on and so forth. And that nonsense, it doesn't cost that to execute a trade, not at all. But the reason that they're doing it is because, well, they feel that they need the trust of this very prestigious intermediary. If you remove that need, if you remove that notion of trust, I think you get something that's more competitive, because if the thing is going to work regardless of who you route it through, and if reputation doesn't matter all that much, it limits the ability of for intermediaries to charge large fees. Now, some people will try, of course. Especially, I would say there's going to be a cottage industry of. There already is in crypto of people who want to deal with more traditional investors and who are going to reassure them that no, it's all going to be fine. I mean, we see it. You could buy Bitcoin and even hold it with a custodian if you're worried about self-custody risk, right? But nonetheless, you'll find funds which charge you, management fees for holding this. So there's some people are always going to want that, but it's still it's putting some pressure down on costs.
Can you talk a little bit about your background and the founding of Tezos? Because you were a trader at Goldman Sachs, right? And so what did you do? What was your position in traditional finance originally? And what did you see early on that you thought there was like an opportunity to port some of these ideas, or the opportunity you saw in creating your own chain?
Well, my background is in computer science and statistics. And my first jobs I was working on as a quant.
Yeah.
So I started out in statistical arbitrage, and then I moved to in 2009. I moved to Goldman to do high frequency trading. Worked on ETF market making, natural gas market making. I also worked at Morgan Stanley and a few other places on these topics. I've also done some robotics after that, but it was quite different. The thing that attracted me to cryptocurrencies is it was at the intersection of a lot of centers of interest that I had. I have been interested in the theory of money and banking for a long time. So, how does money arise? What makes good money? What makes bad money? And I remember, way before Bitcoin, convincing myself that the best money possible is backed by nothing, right? If you use gold, for example, there's a problem with the fact that if demand for gold increases, you get more mining. And so, that's a waste. Because gold is used as a monetary instrument. In an ideal world, we would have mined all the gold, and increased demand doesn't create demand for all this, because it doesn't serve a purpose to have more gold once you have a given supply. And I guess we could argue that having elasticity in the monetary supply can have some value, but I didn't see it that way. And when cryptocurrencies come around, I mostly notice bad criticism around it. So people always say like, "Oh, it's backed by nothing," and I'm like, "No, that's great. That is what you want with a currency." I was interested in the cryptographic aspect because I also had, I have a mathematical background. I was interested in cryptography. The individual sovereignty aspect was also something that appealed to me from a political standpoint. So it really attracted me early on.
So you were one of the first ones to move from proof of work to proof of stake. Is that right?
No, we never used proof of work.
Right. Sorry.
Proof of stake from day one.
I mean, you were one of the first to actually do proof of stake. What was it like? What was the opportunity there? And why did you immediately latch on to that versus proof of work?
I got interested in doing Tezos because of my interest in proof of stake. Around 2013, there were a lot of innovation in the space around proof of stake, smart contracts, privacy, people were coming up with, it was an explosion of research and innovation around the space. And one thing I noticed early in the Bitcoin culture is that there was not a whole lot of appetite in trying to integrate any of these upgrades into Bitcoin.
And it's sort of a point of pride for them, right? Like that the code is so ossified, or that it's so hard to.
There's a big part of it is pride, but I also think part of it is sour grapes. You know, for a while the narrative was very different. For a while was people in Bitcoin circles were saying, you know what, all these altcoins is just laboratories. They're going to find the best, ideas, and we can always integrate those ideas into Bitcoin. And we moved from that to, all those ideas are bad. Yeah. And we couldn't benefit from any of them in Bitcoin, which I think is a little sad because a lot of these ideas are good and important and have found product market fit.
This is one of the ironies of Bitcoin. I think it's technology is going to save us in many ways, but also we don't want the technology to advance too much because we like it the way it is, or we can't actually do it.
And I understand the perspective. I think from the Bitcoin perspective, there's a big risk if you let people change the ledger, that the changes that you end up having are not merely technological improvements, but actually change the nature of Bitcoin and it change its economic properties. So I think what all of Bitcoiners feel is that if they open the door to technological changes, they're also going to open the door to social control of the economic properties of Bitcoin, which is something that they absolutely do not want. So in some sense, they felt like they had to shut the door completely almost completely on changes in order to preserve the economic properties.
Let's talk a little bit about what you see happening on chain. We had a recent episode of the podcast with another person who once did ETF market making or ETF trading, Sam Bankman-Fried, and he was asked to describe yield farming. And we thought we were going to get this sort of very complicated answer about, I don't know, something. But it turns out in his characterization, yield farming is they'll pay you to put money in a box. And if you put money in a box before other people put money in the box, then you have a bigger part of the box. And it sounded to a lot of people not that different from a Ponzi scheme. What did you think about that? Is that a fair characterization of yield farming?
I think it's a fair characterization of the way it's practiced. If you weight by volume, or by prominence, then yes, it's a fair characterization. I wouldn't throw the baby with the bathwater. I think there's something there. The more generous way of looking at it is, let's say you want to launch a token, you want to distribute it in some way, you want to get some liquidity, so you use part of your token supply as a way to incentivize people for providing liquidity for it. And you could see a company doing this. You could do this with equities. You could say, look, I have some equity. My business will be more appealing to investors if there's liquidity around this equity. So I could set aside some equity and incentivize my investors to provide liquidity.
The issue with that it seems to me, and I think we have seen this in crypto, is that once the equity is distributed, if your model inherently is about, I guess, paying for customers in the form of equity, then once all the equity is distributed, do you really have good customers, or do you just have a base of people who are going to now go find the next company giving out equity for liquidity? And when I look at crypto, I look at all these DeFi protocols that were huge in the summer of 2021, and now their charts are way down. And I kind of get the impression that the game is, yes, you find the company or the protocol giving out governance tokens, as they're called, equity. And then at some point the equity runs out, and rather than sticking around, you just go find the next thing.
Yeah, no, I don't disagree with that. There's a lot of it's very circular. The way I phrase it sometimes is that you see a lot of innovation in DeFi from a technological perspective or even from a financial engineering perspective. But the point of DeFi cannot just be to trade DeFi tokens.
Right.
And right now that is mostly the point of DeFi. So you need to, I think you need to anchor it to some real use case and where real demand comes from.
So historically, Tezos has avoided DeFi, right? You haven't been that involved in it in the way that, say, Ethereum has. But I think you started something last year called Liquidity Baking. Is that right?
Yeah, absolutely.
Can you explain that? How is that different to the other bad yield farming all the way down type DeFi?
Of course. So first of all, I would challenge the fact that Tezos has this skewed DeFi. The way I say it is, Tezos is not sentient. It's a project, and they are DeFi protocols running on Tezos. The Tezos Foundation helps, in general, the growth of the Tezos ecosystem. We distribute grants, and we've given some grants to some DeFi projects. So there's no, there's no animosity or anything against DeFi. I think it has had a little less traction on Tezos and on other chains for a variety of reasons. But yes, so liquidity baking is interesting. It was a modification of the protocol itself. So at the protocol level, an amendment was passed and ratified and voted on by the validators of the network that would take a small fraction of the very small fraction of the tokens minted on every block, and then use that, deposit that into a pool to incentivize liquidity provision between Bitcoin and Tez. So the idea is that you have a little more inflation in your protocol. I think it comes down to about 0.3% per year. So it's not very, very meaningful for something that has a daily standard deviation of like about 5%, like a few percent. So it's 0.3% per year, but it incentivizes people to be willing to provide liquidity between Bitcoin and Tez. And the point is that, first of all, these are not gigantic yields. The point is not to try to attract people with gigantic yields, or the point is not to try to bootstrap something new. It's a cost. You pay a very small cost in terms of inflation, and you get something in return, which is liquidity provision.
I want to go back to the box for a second, because in theory, the box could become a bank, right? So in theory, we could all put money into the box, we get some equity, and then in theory, it could start, I don't know, making loans or doing something with economic purpose, something that actually creates value such that DeFi is not just trading of DeFi tokens.
Right. This is like the SPAC argument, right? You're sort of putting money in a box that might become something. Maybe,
but is anything becoming that?
I mean, there's a famous crypto SPAC. You basically have something that's nonsense, you get a high valuation, and then you turn that into actually making something that works. We've seen some people attempt that. I don't know that anyone has really succeeded at pulling off the crypto SPAC so far. But it was an interesting move. Certainly, like people pointed at projects like Chainlink, for example. Who, started out a little, not very coherent, and then started hiring serious academic and doing really serious work in cryptography for this. So it remains to be seen whether or not that's pulled off. But for me, it's more about it's not about how serious you are. It's more about at the end of the day, it's about value creation. Like, what value are you creating? And it can't be completely internal. Another way to think about it is sometimes I'll visit a small town and I'm thinking, what are the exports of this town, right? So you have economic activity, you have restaurants, but the restaurant is for the people who work here, so they have to work on something. So at the end of the day, what do you export? What does DeFi export?
Yeah, that's a good question.
Right? What are you doing? Because if you're looking at there's a cynical view of financial markets that I really reject, which is the idea that all the financial market is just a giant casino, everything is zero sum. It's a very popular view, but I don't. Financial markets are very important because they help get liquidity. Secondary market get liquidity, and it helps capital formation for companies, and companies actually build things.
Yes.
Right. So there's generally value in financial market. It helps companies that do things and build things, and unless you're actually doing this in some ways with DeFi, it's going to remain incestuous and it's going to remain circular.
Since you said this, since you're not a fan of DeFi for the sake of DeFi, can I broaden this out massively and ask, what is the use case of blockchain? And we ask this all the time. And, yesterday, Joe was on a panel with Algorand, and they announced a big partnership with FIFA. And Joe asked the FIFA president, well, what are you guys going to be doing in this new partnership? And he basically said, we don't really know. We have a bunch of ideas. We're just really into crypto and we want to be a modern company. And we hear so many of these partnerships, and I feel like it's still kind of unclear what it is that you can do with a blockchain like Tezos versus traditional technology or financial architecture. Yeah,
absolutely. So I think for me, the most basic use case, and maybe the most important one, is censorship-resistant store of value, like being able to store wealth in a way that isn't anyone's liability. Because if you think about it, if you have a bank account, that's still the bank's liability. If you have a brokerage account, you probably don't even own, the shares in name. And even if you did own the shares, it's still the company's liability, right? The shares are like liability of the company to you. There's very, very few assets which are not someone else's liability. You have real estate, but it's not easily portable. You could own precious metals, but again, as bearer assets, they're kind of complicated. So it's unique in this respect. It's a bearer asset that you can transact with across the world. So that's a second use case, making very easy cross-border payments, very cheap cross-border payments without intermediaries. And I think, if you live in a reasonably free country, it might not seem like a big deal, but as soon as repression starts turning on, you're pretty glad that you have a censorship-resistant store of value. That viewpoint often gets a little derided because people will point at people holding Bitcoin or these other cryptocurrencies and say, well, look at them, holding Bitcoin on exchanges. They're not concerned with that. Well, maybe they're not, but maybe they think that other people are going to be concerned with that, and they help set a price for the store of value. So I don't, it's you're basically either using a store of value or speculating on the fact that people are going to use the store of value. And I think that's completely fine.
So here's my other very broad question, which is, do people actually care about decentralization in crypto? And then secondly, how do you measure decentralization? And again, I asked the question because this happened again at Milken, but Cathie Wood from ARK was talking about the new thing they're working on is some sort of systematized way or systematic way to actually measure decentralization in crypto. So how do you actually do it, and does it matter?
So if you're looking today at the behavior of price setters in markets, whoever is, the marginal buyer for cryptocurrency does not care about decentralization, right? And I think that's been pretty clear. But I believe that for these systems to present some value, they need to be decentralized. Otherwise, they'll be outcompeted. If you have some use case for your blockchain, you have to ask yourself, what do I do that Amazon AWS cannot do better as a service?
Right.
And I think the answer to that oftentimes is going to rely on decentralization. So there's been a decoupling in the sense that people don't care. But at the end of the day, when the rubber hits the road, decentralization does matter. But I think we're going to need to see more cases of blockchains being insufficiently decentralized and running into trouble for people to start caring.
How do you measure it?
Decentralization?
Yeah.
There's many ways to think about it. You can have the, I would say, de jure decentralization, where there's no single party is in charge. But then de facto decentralization is not only is that true, but on top of that, no party is too prominent or has too much of an impact on the network. And then you could be looking at it in terms of the most narrow sense would be the consensus algorithm, who can attack the integrity of the chain. But it could also be, who has influence in this network, who has the clout to suggest hard forks, for example. It could be who is building infrastructure that's critical for this. So you have many, many degrees of that.
So just on this topic, I mean, there do seem to be benefits and drawbacks to decentralization. And we've seen, for instance, with Ethereum has a figurehead in the form of Buterin, and they have been able to do some stuff relatively quickly that probably a truly decentralized protocol would have difficulty doing. And I think Tezos has a unique governing structure where you are quite decentralized, from what I understand. So has that been, how do you feel about that? Has that been a drawback, or is that a big benefit of the protocol? And how do you weigh those two things?
Well, I think in general, decentralization is a cost, right? That you have, and there's benefits associated to that cost, right? So I think it's worth paying, but it feels almost like an insurance premium, right? You pay the insurance month after month, and you say, "Why am I paying this insurance?" And then you have a fire, and you're glad you paid for the insurance. Mm-hmm. So it's very easy to see the cost of decentralization, and the benefits are not always as obvious immediately. In terms of Tezos, we have a governance procedure that allows for upgrades to the chain. So anyone can propose an upgrade on a Tezos chain. And it's set to a vote. And if the vote passes, and it's a very conservative vote, happens over 3 months. But if the vote passes, the upgrade is adopted. There's a side effect, though, because in order to have a mechanism that completely automated upgrades through voting, a lot of engineering work from the very beginning went into making easy upgrades. And just as a side effect of that, that's a benefit, unrelated to the decentralization. It's just the fact that it's really easy to do hot swaps of the protocol has led us upgrade faster. We've had about 9 upgrades in the past 3 years, and we have the 10th upgrade being voted on right now.
I want to go back to Tracy's question about use cases because, okay, store of value, I get it. Cross-border payments or payments, I get it. But on the other hand, like, I kind of think Bitcoin has solved those problems. And so, or to some extent. And so when I think about like a smart contracting platform, and when I'm here at Milken and everyone is talking about, oh, we're going to be trading real estate on the blockchain or virtual worlds and, virtual land and where like, your cartoon ape can live or whatever. I want to push further on like, what can we do with a blockchain that we can't do with a traditional database? And what that's going to look like and what applications are going to take off and actually change society. Or as you put it, and I really like the phrase, and I'm going to steal it from now on, is like what are the blockchain's exports going to be?
Yeah. And I think, the most natural, the highest impedance match is store of value. And then we go down from there, but there's still a lot of values that's present. So we did there was a fair number of security token offering on the Tezos blockchain, and a lot of them have come from the real estate world. And they were people.
Sorry, the what world?
Real estate world.
Oh yeah, okay.
There were a lot of people tokenizing real estate on blockchains, and they weren't doing it. It was not an innovation lab at a bank saying like, "Oh, we got to do something with blockchain." They came from people who actually had the need and actually had the use case, and they saw the value. And I don't think it's impossible for a centralized system to do this. But having a system that's secure, that's automated, that's global, I think the global aspect, the fact that it just works, and you have this entire infrastructure around it. You have wallets, you have custodians. Think of it as some sort of layer that plugs into a large ecosystem that supports it. That lowers your cost. So there's value here. It doesn't come straight from the decentralization. I think it comes from the network effect of having a generic platform where you can build all sorts of things. So
I have a dumb question, and I think I've asked this before, which probably makes it extra dumb. But when you actually tokenize something like real estate or, a JPEG that becomes an NFT, what exactly what are you buying? Because my understanding is you're basically buying a database entry, and then there has to be some external body, right, like an OpenSea that points you in the direction of it.
And also, just to add on to it, in theory, there needs to be some legal recourse, right? Such that the owner of that token actually is entitled to the cash flows of the property, whether that's in the rent or in the sale of it, as opposed to whoever just happens to be there takes the money.
Yeah. There's a lot of arguments around this space and I've been guilty of that if you follow the argument, you will reach very strong conclusions, and then there's always some subtlety. You see like, oh, this could be centralized and therefore there's no value. And so, for example, the legal resource is a really good example. Sometimes you'll hear, look, there's no point in having tokenized real estate on a chain because at the end of the day, you're not going to be able to, if you want to assert your right, you'll have to go to a court, you'll have to go to like whoever the issuer is. They can refuse to honor it. So all the security of the blockchain is for naught. And I think that's taking the argument way too far. There's a saying that possession is 9/10 of the law. And in some sense, smart contracts is automated possession. So sure, you could have legal challenges, you can have all sorts of things, but it reverses the burden. I think it's Nick Szabo who says that smart contracts reverse the burden of the lawsuit. And that's really interesting because, you'll get transferred the title of something. You can start doing things because, hey, it works with lending protocol. It's integrated in everything. And if people somehow think that, you're not entitled to it, they have to sue you and they have to claim it back, as opposed to you saying like, hey, I need this. So, and you see this in the traditional financial system in the form of escrow, right? If you have a small party dealing with a large party and they say like, look, if you don't pay us, there's no way we're going to be able to sue you, right? So you use escrow for that. And I like to think of smart contracts as automated escrow.
Escrow exists because the two parties don't trust each other. So the solution that you're creating is basically trying to fix that trust problem. But I guess my question is, it goes back to that what are you buying aspect. So I buy tokenized real estate. I still have to trust the person who's selling it to me because there still has to be an entry somewhere, or there still has to be a centralized party that's telling me that this database entry points to that thing over there.
Absolutely. But I still say you trust them with less than if you were just signing paper documents.
So it's a matter of degrees.
Absolutely.
Okay.
And in some sense, with the JPEGs and the arts, I think it's more trustless in some sense with it, because there's nothing tangible, right? It's not like somehow they can say, no, you don't own that. You don't own that thing, because what you're buying is I think if you buy a piece of art, for example, and just to be sure, a lot of people buying JPEGs are just buying it because they see it go up and they say like, I'll buy it and then I'll sell it tomorrow. There's a lot of gambling associated with it, right? But there's also a genuine art community. There's like genuinely digital artists who are minting digital art and selling it. And the argument that I like the most here is like, okay, so digital art is a thing and that's not going to go away. Mm-hmm. People want to collect it. People always want to collect art. So what's the alternative? Before that, people would collect digital art and they would receive a paper certificate saying you own, you own this piece. You're not going to put it on some corporate database. You want something that's going to be here for the long run. You want something that gives you some meaningful form of ownership. So the best substrate for that is a blockchain. So I do think there's a really good impedance match for art, digital art, and blockchains.
Let's talk a little bit more about what the future looks like. And, Tezos is an Ethereum competitor. And a lot of the things that you can do on Tezos, you could do on Ethereum and presumably on Solana and Avalanche and the Binance chain and all these, and Algorand, et cetera. Is your view, and this is a question that I was wondering, like, in your vision, is there one chain that wins out? Is it, you would want it to be Tezos, but are we going towards one chain that's the winner, or is it, as they say, a multi-chain world?
So again, to my point, there's absolutist arguments where you can say, well, there's network effect in having one chain. Like you have more security, you have more assets, more composability. So one chain wins all. And there's limits to all this absolutist argument. The way I like to think about it is, if you have salts in a solution and then you let it crystallize. If you crystallize very, really quickly, you get something like glass. If you crystallize very slowly, you get a few big crystals. So the lowest energy state is just like one big single crystal. Mm-hmm. But you're not going to get to the lowest energy states because at some point you'll have things that crystallize. So what it means is that yes, we have a multi-chain world, but the applications on the chains will stay because they have their own network effects. So I don't think we're going to have chains that specialize on a use case in a technical sense. There's no way you can meaningfully say, oh, this chain is the best technologically speaking for sports, and this chain is the best technologically speaking for finance. The designs are largely going to converge. However, if you have a lot of really, really popular applications which are talking to each other and form their own ecosystem on a chain, they're not necessarily all going to migrate away from one chain to another just because they can get, epsilon more security in doing so.
Can you talk a little bit more about that interoperability point? Why is it so technologically difficult? Give us a really easy to understand explanation of why it's so technologically difficult to make the chains work together.
The main thing that a blockchain does is maintain consensus, right? Mm-hmm. That's a hard problem that they solve. And if you want to have two chains communicate with each other, they need to be in consensus with each other. Each chain needs to know what state the other one is in. Mm-hmm. But at this point, if to have them be in consensus with each other, you would need to have all the validators of one chain be all the validators on the other chain. And by the time you've done that, you've essentially merged the two chains. So fundamentally, bridges that port state from one chain to another are hard. You are either increasing the computational cost on your network or you're losing security properties.
And some of the big hacks, and I don't think we've talked about it on the show before, but some of the big hacks that people hear about in crypto lately have been on these bridges, right?
Yeah.
So can you talk a little bit about what's going on? Why is security inherently difficult, and what have exploiters discovered about the weaknesses inherent in these bridges?
So first of all, the bridges are big honeypots because in general, the way a bridge works is you're going to put all your assets on a chain in one little pot, and then you're going to mint a representation of those assets on the other chain. So you have a big pot of money that's sitting there. So first of all, you're a really good target for hacks.
So I lock up, say, $10 million worth of value on Ethereum, and then I mint $10 million on Tezos that represents a claim to that 10 million on Ethereum.
That's right.
So that's a lot of money. All right. So that's a honeypot, but keep going.
Yeah, but that's the first thing. It's like, what motivates security attacks is money.
Right.
And the second thing is, so it depends. Not every bridge is created equal. And then some bridges have way more secure design. If you look at, the entire Cosmos ecosystem is built around the idea of having these bridges, light client bridges between chain. Now that's more secure than other approaches. But a typical approach is you're going to have a set of signers. So a set of people who are going to monitor both chains. They're going to see what happens. And then they will sign messages saying like, yep, I got deposit on this chain. And you notify the other chain that deposit happens and vice versa. But those signatories have the power to take away the funds because they could pretend that the deposits happened that never happened, or that a withdrawal happened that never happened. They need to be in consent. They need to follow the two chains. But there's a lot of attacks you could do. First of all, if you have, the Polygon, for example. So Polygon is it's an L1 chain that markets itself as an L2 chain on Ethereum. They have 5 billion.
Sorry, explain that. Just quick diversion. What do you mean? It's an L1 chain that
so Polygon is an L1 network.
Okay.
And the proof is that they are actually investing in L2 solutions. If you're an L2, you don't invest in L2 solutions for scaling yourself. But as far a lot of their marketing initially was like, no. Bill on Polygon is just like billing on Ethereum because we're all part of scaling Ethereum, but their incentives are at odds with that of the Ethereum ecosystem.
All right, keep going.
It's been a good growth hack to say like, no, we're complementary to Ethereum, but everyone's competing. And so the Polygon contract is a 5 out of 8 multi-sig. And it has like a few billions of value. Like if you're holding a signature and you have...
So there's 8 people.
Yeah.
And in theory, to access those billions, you just need to get 5 of them.
That's right.
Okay. Just high stakes.
Yeah.
Okay.
And it's high stake. And where are you going to put this signature? You're not going to put it in your apartments. Right. You need to be able to access it. So you can't even put it in the bank vault. So you need some sort of probably some data center. But even if you have a data center now, you have to think of like, well, who has access to it?
Right.
When there's billions, if your attack is worth billions, the budget that you have for actually triggering things. You have people being kidnapped, for example. There's a lot of.
Wow.
For billions of dollars, it's not impossible. Right. People have been kidnapped for a lot less than that. So that's there's a lot of risk associated with running a bridge. If you look at Axie Infinity, for example, so they're not on Ethereum. They're running a clone of Ethereum, and there's a bridge. And they were hacked for like 800 million or something like that. And it's easy to look at this and say like, silly NFT games. They got hacked. They're probably sloppy with security. And I have no idea. What's backing it. But I've seen a bunch of people say like, apparently the evidence points at them being hacked by North Korea, because for 600 million for North Korea, that's a lot. That's a lot of that's meaningful money. But if your adversaries are nation states. Right. That puts the security, and you don't really have the security problem. Like the way that blockchains are designed, like the security works a lot better. Everyone's responsible for their own safety. You don't have this giant honeypot of all the funds of the one bridge, which are in the same place.
This actually reminds me of something that I wanted to ask you, and it gets back to the multi-chain versus absolutist argument or tension. And I guess Tezos has been around for a long time, and you've been doing this for a while. You're well known in the industry. You've talked to a bunch of people. You have different partnerships. What is it like actually going out and selling the technology to a company or convincing some sort of entity to use it? Like, what is that, I guess, endeavor like, and how do you compete against something like Ethereum or Solana or whatever?
Yeah, so in general, I don't go around to companies who have no interest in using blockchains and tell them like you should be using because in general there's some existing interest.
I'm sure some blockchains do that. There's probably a few of them at this conference.
Yes, it's quite possible, but by and large, people are even every large institution has at least every bank since 2013 has like an innovation center that actually wants to do something in blockchain. Right. So there's already like at least some existing interest and some ideas of doing something. So it's more about like why should we use what should they use Tezos as opposed to any other blockchain, and then we rely on some of the good attributes of Tezos, which is very strong decentralization. The fact that we have a really good software stack for building secure application. It's, I think, a lot easier to verify the security of contracts written on Tezos and on contracts that use Solidity. Good developer community. Sometimes it can just be hand holding. Sometimes people say, you know what, I've tried to build on this chain and I couldn't find any help. And being able to go to these people and provide technological expertise makes a big difference.
All right, I want to get your take on another big thing that's going on in crypto right now that's attracting all kinds of controversy and Medium posts and tweets. And that is the chain Luna. And is like this. So the deal is, in my understanding, maybe you'll explain it better, but there's a chain called Luna and they have a stable coin called UST. And you can get 20% on UST if you buy this coin and then like stake it, and people are making tons of money and it's going up. And then also I think the Luna Foundation is buying a bunch of Bitcoin, like billions of dollars worth, to build this war chest to hold the peg of the stable coin. Because to hold a stable coin's peg, there's a lot of interest in stablecoin architecture and design. And some people think like this is like going to blow up. And someone once told me it's like all the stuff that you're worried about with Tether, you should be looking at Luna. And other people are super bullish on it. What is your read of this situation? I see more talk about this story than a lot of other things right now.
Yeah, I have my theory is no convertibility, no parity. So if you cannot convert your assets from your dollar stablecoin into dollars, you're not going to have any form of parity.
Right.
And it's such a powerful law. I mean, even you saw it in equities. The classical example is Shell Royal Dutch, where after
Royal Dutch Shell,
where after a merger they had shares trading in Amsterdam and shares trading in London, and there's the same equities. They give shareholders exactly the same rights, and one traded for years at like a 15% discount to the other, and they're the same instrument, but because you cannot convert one into the other, so if you cannot just hope that people are going to be rational. You need arbitrageurs to be able to come in and use the arbitrage. So with a lot of fractionally backed stable coins, the arbitrageurs can do that to some extent, but the system relies on constant growth in the number of people who want to hold a coin. And if you don't have this growth, and if you have, as soon as you go through a contraction and people start asking for redemption, then the system collapses. Mm-hmm. So that's how Basis, for example, is built, and that's how or wanted to be built. Luna is a little different. What they're doing essentially is they're saying, okay, so we have an idea of the price of Luna in US dollars, and so anyone who comes in can issue some against, can burn some Luna and issue some UST, or do the opposite, and we're going to pay 20% because that's great. It will. Yeah. It's a growth. It's a way to grow. The difficulty with that is that there's no limit to how much UST can be created, and the Luna holders are actually paying for the 20%. The 20% are coming from somewhere. Now they're happy to do it because they're saying, well, the growth and the demand in the stablecoin creates visibility for the ecosystem. It creates hype and it creates market cap. But there's limitations to how that works. What they don't do, what you need to do, is that you need to be able to set the interest rate in a way that's going to balance the supply, and the supply should be determined by what's backing it, and the demand, which is how many people actually want to hold this stable coin. And they don't have a mechanism like this. And instead of building this mechanism, because you could do that, you could do something where you say, look, we want to have no more than 30% of the market cap of Luna being into UST, and if we have more than 30%, then we'll lower the interest rate, including potentially going negative. And if we have less, so there's a mechanism that works. Instead of that, they're going and saying, no, we're going to buy Bitcoin, which is if you're going to have also some centralized ownership, and go and buy some USDC or some dollars. Like, why would you?
What's the rationale for doing? What do they say? Is the
the rationale is headlines.
Oh,
it's okay. Like, wow, we're the biggest holder of Bitcoin. How cool is that? Or potentially is the idea that maybe Bitcoin appreciates and that helps us with our unbacking problem.
Yeah. Since you mentioned arbitrage there, I was wondering, given your ETF market making background, do you see a lot of parallels between the world of crypto and ETF trading?
ETF trading, not per se, right? Not directly, but just having a general financial background, I think, is helpful when looking at a lot of DeFi protocols and understanding how they work or don't work.
Mm-hmm. I have a question, and again, it's sort of about these parallels. So people got hyped up about blockchains early 2021 when the Robinhood stuff was going on and people started learning about payment for order flow and like, oh, you're giving a penny or a millionth of a penny on every trade to some high frequency trader jumping ahead of you and so forth. But crypto or blockchains themselves and Ethereum and other smart contracting platforms have this concept of MEV, miner extractable value. And if I want to place a trade, blocks only happen every once in a while. And in theory, that trade goes out there and everyone can see it. And a miner can jump ahead I think is how it works. So essentially jump ahead of me and get a better price on that execution and then sell it back to me and I get a worse execution. How big of a problem is this? Can you talk, and how does it work on Tezos? And what are the sort of things that people should understand about the power that miners have, or the how MEV comes out of the system?
Wow, that's a big.
I know it's these are things that we haven't really talked about before, and you're good at explaining these things, so I figured I would just give you a bit more.
I'm happy to dive into it. So the first thing to understand is that order flow is not fungible, right? Order flow that comes from retail trading is not the same thing as order flow that comes from Goldman Sachs or that comes from a fund manager. If I come to you and I say, hey, I want to buy this equity from you or this shares from you, like, sure, or maybe not. But if Goldman Sachs come to you and say, hey, don't you want to buy this from us?
All right, so this is retail flow is much more desirable because we're all dumb.
It's not even that it's dumb. It's it's just not informed. You're buying, you're buying it because either maybe you're gambling or because you're saying I like this stock, I want to buy it for retirement and so on and so forth. This is not you have just received some information through a wire about something and you've done all of that and now you know that the execution is going, the price is going to go down. So it's quite different. And once upon a time, you didn't have to mix all the order flow together. So if you were a big fund manager and you have this large S&P fund and you need to rebalance and you talk to another big fund manager and they need to rebalance and then you strike a deal because you know that the other person is not trying to screw you, right? So they're trying to do the same
You're trying to solve a mutual problem.
Yes. And also you're going to do repeat business with them. So that's quite important. And that's, that happened upstairs in IC. And then at some point, the SEC looks at this and say, well, we see all these big trades happening and they're very advantageous, but the retail...
This is Reg NMS, right?
This is Reg NMS, yeah. The retail guy doesn't get access to that, so we're going to put everything on the electronic exchange.
Right.
And brokers will have to route to whichever exchange has the best, the NBBO, the best big and ask. And a lot of institutional investors, when they start doing that, they had no idea how to do it. So now they start showing these big orders, or even if they chop them up, they don't do it they don't really do it in a way that hides the amount of volume that they want to do, and they get eaten by high frequency traders who appear as a cottage industry as soon as the Reg NMS is passed. And so a lot of these big sell side people get very, very upset at it. And if you read Flash Boys, it's a very one-sided book that talks only about the sell side doesn't interview a single person on the high frequency trading side.
I remember there was this crazy bit in Flash Boys where he was talking about he was about to do a retail trade and he was about to click order or buy, and then he saw the price move on his screen and he was convinced that it was because Goldman Sachs was front running his tiny retail trade.
And it's bizarre because it's also presented, I think, in 2010 as I'm uncovering this big secret, and I'm I started working in Goldman Sachs in 2009 because people were talking about this on TV and I thought it was cool. So this is it was on CNBC. It's not they were uncovering a big conspiracy. And people adapted, of course. So they started using execution brokers, where they will say, no, we'll take your order, chop it up, and then put it on the exchange. But so now, as a result, what happens is you get internalization of flow. So you get this retail flow,
right?
And if you send a retail flow to the exchange, the retail is going to get a worse price because the exchange doesn't know anything. The exchange says, whoa, wait a second, we don't know who you are. You could be retail, you could be a hedge fund. We're going to be giving you wide quotes because we don't know. Whereas as a broker, you know the order flow is not toxic. That's a word that's used for informal flow. It's not informal order flow, so you can give it a better price. So you're going to match it internally. You're going to give it a better price than the NBBO, which you're allowed to do that. You're going to report the trade to the exchange, and that's it. Or you're going to give the customers the NBBO, but actually you internalize it for something better. So the customer feels like, oh, I haven't paid anything,
Right.
But actually you've made money because you can quote tighter on your internalized flow than you could on the exchange. So retail really won out of this. Like the small retail guy who's like just buying single name stocks, market's much more liquid for that. I would say the losers out of this have been large institutional traders who now have to either use execution brokers or dark pools.
So here's a very broad question based on that very long and detailed answer. But what is crypto trading like behind the scenes of exchanges? Like how transparent is it, and what sort of execution are people getting?
Right, and all the MEV aspect. So it's like what are the equivalents? Like how big are some of these?
So the equivalent to MEV is putting your giant order on the exchange, and everyone knows what you're about to do, and so people can get ahead of you. The difference is that if I put a giant order with my broker, at the very least, the broker has a fiduciary responsibility towards me. I'm his client, and so they have to do things a certain way. Whereas I don't have any fiduciary relationship with the miner.
Right.
Now, there's nothing stopping people from building these relationships. As a trader, you could go to block producers and say, I want you to promise me that when I send you an order, you're never going to include, you're never going to show it to anyone else, and you're going to include before everybody. Like you could do that, but people don't do it.
Do you think that's going to happen?
No.
You don't?
No, I think what's going to happen is people are going to build better protocols, which are going to remove some of the extractable value.
Do you think regulation will come to the space? Like, will the SEC, for instance, get interested in best execution for retail traders in crypto?
So I don't read tea leaves. I think it's possible because people have made MEV into some sort of moral issue, which I think is dangerous. The word saying like, oh, the miners are exploiting people, they're taking advantage, and so on and so forth. One thing that I think would be more helpful to frame it as, and again, I said, is like, if you want a fiduciary if you want a fiduciary relationship with your miners, you should ask for it. What I would worry about is a regulation that says that by default, as a miner, you have a fiduciary responsibility with these people, which I don't think you should have.
What about if I have a fiduciary responsibility with a brokerage that, for instance, is providing me crypto exposure through my 401k, as I think someone is doing now? I forgot the name, but various people are starting to do this in a sort of more regulated way. How does that fit into the execution bill?
Well, in that case, of course, the broker should not like favor another client or themselves in doing the transaction. Now, but if they trade, and just to be clear, this happens for on-chain trading when you use DeFi protocols. It's not directly an issue with trading on centralized exchanges. I think first of all, a lot of it comes from the latency of chains. The more latency you have, the more MEVs there's going to be, because quotes are not adjusted in real time. So it's partly a fraction of that. And the way in which protocols have been designed, if you are in a system where you can't adjust quotes really rapidly, you need to build batch transaction mechanisms, and they're harder to program. But once you have this, you can reduce the MEV on exchange a lot. And I think we'll see that happen.
So just going back to the turtles at the beginning of this discussion and plastic bags on the blockchain, I was packing up my apartment in Hong Kong a few months ago, and I noticed that a bottle of balsamic vinegar that I had that I'd never used was on the blockchain, right? You could trace it to test its validity. And big existential question here, but is the future just everything on the blockchain? And how do you differentiate between the importance of having something like plastic bags being tracked and traceable versus having something like a store of value that people are using to hedge against inflation or for whatever reason?
Well, I think there's more value in the store of value aspects than the supply chain applications. A lot of the supply chain applications we see on blockchains, honestly, are stone soup. You'll see IBM go to these people and say, put everything on a blockchain. But if you digitalize your entire chain, right, where you have, like you can scan QR codes and do all of this and put it in a system, and then, like you've solved 99% of your problem, and then you put it on blockchain, why not? But that's not really what's driving the value. I believe there's value in digitizing and having cryptographic signature on supply chains, absolutely. I don't think the blockchain adds a whole lot to this.
All right. Well, Arthur Breitman of Tezos, thank you so much. That was a great conversation. I feel like we have really good conversations with like the people who did some time in the TradFi trading world. That seems to be like the sweet spot for people who can explain things. So thanks for coming on Odd Lots.
Thank you for having me.
Thanks so much, Arthur. That was great.
I guess I said that at the end there, but I do feel like the best explanations and conversations we have on this space are often with someone who did some like time trading in some legacy institution and can sort of, I guess I would say, like translate some of these ideas
absolutely
back and forth.
But I also feel like there's a tendency in crypto for people to talk about like all these issues are brand new when in fact they have been very diligently thought out many years before by traditional financial institutions. And there's a reason why, they do it a certain way. But execution, for instance, is something that's been top of mind for a lot of people for decades.
I still think people should just chill out. It's like, it's just a penny or it's just a fraction of a penny. What's the big deal?
The other thing that I liked from that conversation was the description of DeFi.
Yeah.
The question of what is the export here? And we've talked about it before, but like, what exactly are we doing other than dealing in more DeFi?
Well, you used to make fun of me because early on in some of our first DeFi conversations, I would like, well, the whaling expedition. And it's like,
I would never make fun of you.
Is the protocol actually, it's like VC. It like got its roots kind of in funding whaling expeditions.
I never made fun of you. I just questioned why you were obsessed with whaling expeditions all of a sudden.
Fair enough. But anyway, like that is like, it's, as Arthur pointed out, like it's not that exciting if it's just tokens, trading and more tokens.
Yeah.
Or it's not that world changing.
Or boxes. Or
tokens, tokenized boxes. Yeah.
All right. Shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me on Twitter at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me on Twitter at The Stalwart. Follow our guest on Twitter, Arthur Breitman. He's at Arthur B. Follow our producer, Carmen Rodriguez, at Carmen Arman. Follow the Bloomberg head of podcasts, Francesca Levy, at Francesca Today. And check out all of our podcasts at Bloomberg under the handle @podcasts. Thanks for listening.